After the ratification of the Maastricht Treaty, the economy of the euro area changed completely. There are two main phases: the first decade from 1999 to 2008, and the second one from 2008 to today. The first decade. At first, there was no paper money for the euro until 2002, so the euro only existed virtually for online transaction and trade. The European Central Bank, ECB, was working hard to make that process run smoothly. A central bank sets the interest rate for lending money to commercial banks. That are the banks that citizens like you and me go to. By doing so, through a complex process called monetary policy, central banks can control, or at least try to control, inflation. To learn more about this process, you can watch the video on monetary and fiscal policy that is included in this web series. The ECB was trying really hard to keep the prices the same so that it would not be too hard for the population. The goal was to maintain the inflation below 2%. The inflation target was not respected, but economy grew, so everyone was happy. It is to be noted that from 2003 to 2007, it was a period of especially high economic growth worldwide. But we all know what was to come, and there were already some signs of weaknesses, such as weak fiscal policies, imprudent practices and instruments that came from the US housing and financial market, and real interest rate becoming negative. Therefore, the euro area was vulnerable to the financial and housing crisis of 2008. Now the second decade, from 2009 to 2018. The second decade includes the years after the financial crisis of 2008. It was devoted to anti-crisis measures. The ECB tried to use monetary policy to face the crisis, but it was no longer enough. Which is why they also used non-standard measures, economic instruments to address the 2008 crisis specifically, such as quantitative easing, QE. Eventually, it worked out after almost a decade. Now the ECB is trying to normalize its use of monetary policy after a decade of using non-standard ones. Along with monetary policy, fiscal policy were used to face the recession. Once again, you can go up and check out the video I did on monetary and fiscal policies to understand the difference between the two. But the crisis was such that almost all the EU countries saw a rapid increase of public debt. A series of severe crises started in countries that are now referred to as the PIGS: Portugal, Ireland, Greece, and Spain, but also in other countries of the EU. They asked for help from the IMF, the European Commission, and the ECB. Ever since, the EU has been working on a series of reforms which include stronger fiscal policies to avoid or at least limit the effect of future crises.